All right, the clock is absolutely ticking on one of the biggest tax-saving moves you can make all year. And look, if you're not paying attention, you could literally be leaving thousands of dollars on the table. So let's dive right into your last-minute playbook for the RRSP deadline. Okay, first things first, get your calendar out and circle this date, March 3rd, 2026. Now, this isn't just some random deadline. This is your final, absolute last chance to make a move that directly cuts down the taxes you owe for a year that's already over. Yep, you heard that right. We're talking about lowering your 2025 tax bill. So, what's the big deal with this date anyway? Why is it so special? Let's break down the timeline because you need to understand why this is such a unique little window of opportunity in the Canadian tax system. This is where it gets kind of cool. See, the RRSP deadline is always set for 60 days after the end of the year. What that means for you is that any money you put into your RRSP in those first 60 days of 2026, all the way up to that March 3rd deadline, can actually be applied backward to your 2025 tax return. It's like a financial time machine. But if you miss that date, even by a day, any contribution you make has to wait for next year's return. Okay, so we've got the why and the when locked down. Now, let's get right into the how. This is your simple, no-nonsense game plan. Seriously, don't overthink this. It really just boils down to these 3 simple steps. First, you've got to find your magic number, your contribution limit. Second, decide how much you're actually going to put in. And third, you just make the transfer. Easy. So let's tackle step 1 right now. Finding your personal contribution limit is actually super easy. The CRA literally prints it for you on your notice of assessment after you file your taxes. Can't find that piece of paper? No worries. It's right there when you log into your CRA My Account online. You can even call them and get it over the phone. No excuses. So where does this number actually come from? Well, the CRA calculates it as the lower of 2 things. It's either 18% of the income you earned last year, so in 2024, or the annual max, which for the 2025 tax year is $31,560. But, and this is the best part, if you haven't maxed out your RRSP in the past, all that unused room just rolls over and gets added on top. It's awesome.
And hey, a quick but really important tip for all you entrepreneurs and small business owners listening. How you pay yourself really, really matters. Taking a salary, that counts as earned income, which creates more RRSP room for you. But if you pay yourself in dividends, that does not. It's a small detail that can make a huge difference in your strategy.
Okay, now for the main event. The reason we're doing all this. Let's talk about the big tax payoff and see the immediate, real-world impact this has on your tax bill. Let's put some real numbers to this. Check this out. This is where you really see the power of an RRSP contribution. Let's say you earned $80,000 in taxable income. With no RRSP contribution, your tax bill is going to be around $18,500. Ouch. But look what happens if you contribute $14,400. Your taxable income plummets, and your tax bill shrinks all the way down to $13,800. Let that number sink in for a second. $4,700. That is your tax savings. That's real cash that stays in your bank account instead of going to the government. And that's the beautiful thing here, isn't it? This isn't some shady, complicated loophole. You're getting a massive tax break for what? For paying yourself first, for putting money away for your own future. It's a total win-win. Now, this naturally leads us to the biggest question out there, RSSP or TFSA. Which one should you choose? Well, the real answer is it depends entirely on your personal situation. So here's a pretty simple way to think about it. The RRSP is your best friend if your income is high right now, because you want that instant tax deduction. It's also great for the home buyer's plan. On the other hand, if your income is a bit lower today and you'd rather have tax-free withdrawals when you retire, then the TFSA is probably your better bet. It's all about playing the long game. But honestly, for a lot of people, the ultimate power move isn't choosing one or the other. It's using both. Think about it. You use the RRSP to get that sweet, immediate tax deduction. Then, when that big, fat tax refund lands in your bank account, you turn around and immediately invest it in your TFSA for tax-free growth. That, my friends, is a beautiful 1-2 punch. Now, before you race off to your banking app, let's just quickly cover a few common mistakes people make. Knowing about these tripwires can save you from some major headaches and penalties. So let's start with a big one. Is it possible to be, a little too enthusiastic and actually put too much money into your RRSP? And the answer is a big flashing yes. Now, the government gives you a tiny lifetime buffer of $2,000. But if you go over that limit, you get hit with a painful penalty of 1% per month on the overage. So what's the bottom line here? I can't say this enough. Always check your exact contribution limit before you transfer a single dollar. Okay, let's think ahead for a moment. You've made your contribution, you've filed your taxes, and boom, a nice refund shows up in your account. What's the absolute smartest thing you can do with it? The most important thing is to avoid treating it like a lottery win. It's not free money. It's your money that you overpaid in taxes. So be smart. Put it to work. You could use it to get a head start on next year's RRSP. You could finally destroy that high-interest credit card debt, or you could top up your TFSA. Just make that money work for you.
As we wrap things up here, I just want you to remember this one powerful idea. Once that calendar flips past December 31st, almost all your chances to lower your tax bill for that year are gone. The RRSP contribution is the big, shining exception. It's your financial time machine.
So really, the only question left is the one you see right here. You have the playbook, you know the deadline, and you've seen the strategy. Are you going to take action? Or are you going to let this opportunity slip by and just leave your hard-earned cash on the table for the taxman? The choice, as always, is yours.